Have you ever pondered over the question, what does it truly mean to be an intelligent investor? This is a question that has been asked by countless individuals across time and space, often leading to profound, enlightening insights about the essence of investing, financial maturity, and wealth creation. As we delve into our topic today, we invite you to join us on an enlightening journey, a quest for knowledge and understanding. The question, seemingly simple, gnaws at the core of our understanding of finance, pushing us to examine the traits that distinguish a savvy investor from an average one. Is it a matter of pure computational prowess, an analytical mind that can crunch numbers and predict trends with unerring accuracy? Or is it more about emotional intelligence, the ability to remain cool-headed and rational when the market is in turmoil? In our quest for answers, we turn to a seminal work in the realm of finance, a book that influenced generations of investors, The Intelligent Investor by Benjamin Graham. This isn't just a book, it's a veritable treasure trove of wisdom, a beacon guiding us through the intricacies of investing. Written by a man widely regarded as the father of value investing, the insights contained within its pages are as relevant today as they were when first penned down. Benjamin Graham was not just an author, he was a scholar, a mentor, a visionary who reshaped our understanding of investing. His book, The Intelligent Investor, provides us with insights and instructions, timeless principles to guide our investment decisions, and a roadmap to navigate the topsy-turvy terrain of the financial world. This journey into the heart of intelligent investing isn't just about understanding a book or its author, it's about understanding ourselves as investors. What are our attitudes towards risk and reward? How do we respond to market volatility? What are our financial goals, and how can we strategically align our investment decisions to realize them? As we continue this journey today, we will be exploring these questions and more. We will delve into the principles laid out by Benjamin Graham, examining how they can be applied in our own investment journeys. We will also explore how these principles have been interpreted and adapted by some of the most successful investors of our time. So, sit back, relax, and prepare yourself for a deep dive into the world of intelligent investing. As we embark on this journey, we're not just seeking to understand what it means to be an intelligent investor. We're seeking to become intelligent investors ourselves. Well, today we journey into the heart of this intriguing query, guided by the wisdom of one of the most influential books in the world of finance, The Intelligent Investor by Benjamin Graham. So what does it take to be an intelligent investor? According to Benjamin Graham, the esteemed father of value investing, it's not about having access to classified information or boasting an extraordinarily high IQ. It's not about who you know in the industry or some secret formula for success. It's not about a keen sense of timing the market or a knack for picking out the next big thing. It's also not about having a fortune to start investing or about having a degree from a prestigious business school. Instead, Graham argues, it's about something far more fundamental and in many ways, far simpler. It's about having a solid intellectual framework for making decisions, a strong foundation on which to base your investment choices. This intellectual framework is built on understanding the principles of investing, of knowing when to buy and when to sell, of understanding the dynamics of the market, and of being able to assess the value of a stock. It's about being able to separate noise from information, hype from reality, and short-term trends from long-term value. Moreover, it's about the ability to keep emotions from corroding that framework. It's about not letting fear or greed dictate your decisions. It's about not getting carried away when the market is on a euphoric high and not getting despondent when it is in a depressive low. It's about maintaining a calm, balanced, and rational perspective, regardless of the wild swings of the market. In his wisdom, Graham introduces us to two types of investors, the defensive and the enterprising. The defensive investor is the more cautious one, the one who is more interested in preserving capital than in making spectacular gains. This individual prefers a more passive approach to investing, focusing on steady and safe returns. They choose to invest in blue-chip companies, bonds, and index funds, trusting in the compounding power of steady returns over a long period. Contrastingly, the enterprising investor is active, always on the lookout for opportunities, eager to put in the time and effort to research and analyze potential investments. They are ready to take calculated risks for higher profits, often investing in growth stocks, small-cap stocks, or distressed assets. They spend considerable time understanding market trends, business models, and financial statements, always on the lookout for undervalued assets. Despite these differences, Graham asserts that both types of investors have their place in the market, and both can be successful in their own ways. He emphasizes that what really matters is not the type of investor you are, but how you invest. He argues that the key to successful investing is not about outsmarting the market, but outsmarting yourself, by avoiding emotional mistakes, sticking to your strategy, and continuously learning and adapting. Graham, however, emphasizes that regardless of the type, every investor must be intelligent. Next, we delve into the concept of Mr. Market, an allegory Graham uses to illuminate the erratic behavior of markets. This notion revolves around a character, a fictitious business partner named Mr. Market, a creation of the great mind of Benjamin Graham, noted as the father of value investing. His aim was to simplify the complex world of stock market investing into an understandable story, allowing even beginners to grasp the foundational principles of investing. Mr. Market in this story is an interesting character with a peculiar habit. He is your business partner, but his behavior is anything but predictable. He has a striking tendency for mood swings, bouncing from the heights of optimism to the depths of pessimism, often within a single day. One can visualize him as an erratic fellow, filled to the brim with unpredictability, constantly swaying between euphoria and despair. Now imagine that you have entered into a partnership with Mr. Market. He has a share in your business, and every single day, he comes to you with an offer. Some days, he's in high spirits, brimming with optimism, and he offers to sell his share for an extravagantly high price. On other days, his mood plummets, and he offers his share for a ridiculously low price. The price he offers is never consistent and fluctuates on a whim, reflecting his mood for the day. In this scenario, if you're an intelligent business person, you wouldn't let Mr. Market's mood swings affect your view of the business's value. You would see through the inconsistencies, the ups and downs, and you'd base your decisions on a rational assessment of the business's potential. You wouldn't be swayed by Mr. Market's irrational behavior. Rather, you'd see it for what it is, a reflection of his unpredictable mood of the day. This is the core of Graham's allegory. He uses Mr. Market as a metaphor for the stock market, illustrating the volatility and irrationality often associated with it. The stock market, like Mr. Market, tends to fluctuate wildly, affected by a multitude of factors that can change from day to day. Yet the intrinsic value of a company rarely changes so rapidly. Graham's advice to investors is a timeless principle that holds strong even today. He urges them to profit from the market's volatility, to buy when the market, in its pessimism, undervalues stocks, and to sell when the market, in its optimism, overvalues them. Yet crucially, they must not allow this volatility to dictate their investment decisions. Similarly, Graham advises investors to profit from market volatility but not let it dictate their investment decisions. Graham also stresses the importance of margin of safety. This principle is all about buying a security at a price significantly below its intrinsic value. This difference creates a safety net for investors against errors and unforeseen issues. It's like buying an umbrella before it starts to rain. It shields you from potential harm. Lastly, Graham highlights the importance of thorough analysis. He encourages investors to commit to extensive research, ensuring that any investment is not just a mere speculation. He also emphasizes that an investment is not just about buying stocks, but buying a piece of a business. In closing, being an intelligent investor, according to Benjamin Graham, is about being disciplined, patient, and eager to learn. It's about understanding that investing is a marathon, not a sprint. It's about not letting market moods dictate your decisions and having a safety margin to shield against unforeseen circumstances. Remember, the defensive investor focuses on avoiding serious mistakes and achieving adequate returns, while the enterprising investor is willing to put in more effort for better returns. Above all, both types of investors need to be intelligent. They need to understand that investing is not just about buying stocks, but buying a piece of a business. So, become the intelligent investor. Cultivate discipline, patience, and an eagerness to learn. Use the market's volatility to your advantage and always ensure a safety margin in your investments. Because in the end, it's not about the high IQ or insider information, but about having a sound intellectual framework for decisions and the ability to prevent emotions from corroding that framework.